Hey guys, it is December the 14th, and the 14th, an unlucky number. Hopefully, though, it ends up being lucky for the markets because we do have the rate coming out at 2 o'clock. So as a result, it doesn't matter what we say in the next 10 minutes, it's gonna do anything because it's really all about what happens at 2 o'clock today. We're gonna continue meme week. And right now, what we're doing is we're gonna go through all the names that have been really either meme stocks or super popular. And I'm going to go through the financials for you so you don't have to just listen to a bunch of people screaming at each other on Reddit and a bunch of emoticons. You'll have, hopefully, by the end of these, enough to where you have a shot at going through the numbers. Now, we've done AMC Ape, we've done Carvana, we've done GameStop. And on all of those, I think I was a little bit more on the generous side, appreciating why people might be interested in them and what the story is. I'm not going to be quite as nice on Upstart, but at the same time, we are going to go through it. And the problem with me with Upstart is not that I don't think that it's innovative what they've done and some of those things, but that there are some actual real problems here. And ultimately, you're going to have to make the choice for yourself. Now, while we're going to move to Upstart fairly quickly, we always set the market up with what it looks like today, so you have some context surrounding what is the environment from which I'm actually making these comments. So let's go ahead with that and share screen. Past performance is not indicative of future returns. Okay, we've got most of the indices hovering above zero, but biased towards the upside towards the upside most of the day. Crude oil coming closer back to the 80 level. Every day we get closer to next year and into the true winter season. It becomes more and more dangerous to play with this crude oil situation, which I do know that the traders are in. And we did see gross exposure in general come down. Therefore, gross exposure down, even though still biased the upside, still will look like selling pressure on oil. But most of that is likely subsided as we really only have 2 weeks left. This week is the last week for options trading. So a lot of the contracts expire. Let me say it that way. You got contracts expiry at the end of this week. So you got a lot of strange activity no matter what. So between that and liquidity drying up for the holidays, you're going to see a lot of strange activity. Hence, if you can have some cash for when stupid stuff happens in the market, because it surely will, and it always does, if you're more of an individual investor, you might find some opportunities in names you like. Okay. I also want to show VinViz. I am a big fan of them. They don't pay me. I wish they would. Maybe there's something I can work out with them at some point. But this is their heat map, and you can see most of the market is green. And then interestingly enough, right before we did this show, we were talking about the fact that a lot of the funds will have to do some selling at this time of year. Additionally, some of them are going to have redemptions front of mind. Some have already told them they want the cash back, so you're going to see selling associated with that. And that may continue in the first couple of weeks of the year if they don't get it all done this year, depending on how they're marking the way that you can redeem. So there is that, it's there. And so the fact that this is green in front of the FOM or in front of the Fed rate announcement is actually, I think, pretty cool personally. But, there's a lot of haters out there. Now, let's talk about Upstart. And I do want to give a little shout out. And part of the reason I'm doing this particular episode, well, first, I should always give a shout out to Gurula .app. Y'all can check out the website. David, who's always on the call with me, I always collaborate with him on this wonderful project, because we are really designed to help investors really make decisions for themselves. As we always say, money goes to where it's treated best. So want to give a shout out to that. Also, I wanted to give a shout out to this little Instagram website that I was communicating with yesterday, Investing with Wes. He had a really interesting comment yesterday. We were talking just on the chatty chat. I don't know him well at all. I just want to give him a shout out because I wasted a little bit of his time. And it was interesting because, the thing that I appreciate about a lot of the young folks that are trying to get started on Instagram, YouTube, etc., who may not come from finance in any way, shape, or form, is that they don't tend to walk outside of the area that they feel the strongest with. And he told me that even though I think he's actually done a great job with the financials and looking at different companies over the period of that Instagram site, he told me that he doesn't typically do banks and a lot of different financials because he finds it hard to walk through all of the different financial statements. And I was really surprised by that. So I thought I would spend a little bit more time trying to make these financials relevant and easy, because someone that bright shouldn't have any problem going through this unless there's actually a problem when you go through it. So I'm going to show you what I saw in Upstart that really, if you're seeing it and you're like, I don't know what to do with that, some of it is like, here, let me explain it. And some of it is, yeah, you shouldn't know what to do with that. There's some missing information there. So first and foremost, what is Upstart? Upstart makes money essentially by its platform, which primarily sits at all these different types of smaller lenders. For example, one of their biggest areas that they lend to is the used car market. Okay. So you can use their platform, and then they have an AI algorithm that helps price the types of loans. So, let's just use auto lending, even though they do personal lending as well. When you go to auto dealership, you find the car that you want. Some guy comes in and tries to sell it to you and asks you if you need financing. And then he goes into the back room and he says, hey, let me see what kind of rate we can get you. They're probably using or potentially using Upstart's software. And that AI algorithm is given a sense for what the rate is, how much you're allowed to borrow, et cetera, et cetera, et cetera. And they take fees and then off it goes. Well, then the reason it gives you that loan is different banks are going to have a feeling about what they're willing to take on as risk or lend out, and not to make it too complex, the banks need to have loans because that's their business. They give loans out. And so they're willing to pay a headhunter fee essentially to be the lender to you, and hope that this AI algorithm that Upstart has is a reasonably good one. And then the second part of what they're getting a fee for is once the bank gives you that loan, the bank is going to, all of those loans are going to have to get moved off balance sheet, securitized out. Okay. So technically something like Upstart should not be holding a lot of loans, because they should be taking in fees for making the loan. If you read your documents carefully, you'll see there's a bunch of fees anytime you get an auto loan or anytime you get any loan. So they should be taking those fees in, and then they should be taking those loans and swapping them right out. Now, typically they keep about 7% of the loans on their balance sheet so that they can run various back tests on them, they said, so they can feel like they are doing a good job with their model on AI. But I'm going to tell you, I got some issues with the way that they're reporting that for me to feel great that their AI model is going well. And remember, I did a lot of time in risk, and I may not have done a lot of time in this particular area of risk, but I would still anticipate that I'd be given a different set of numbers. Not saying that there's a problem necessarily, but it's just, well, we'll get to that. Okay. So this is another piece of their background, comes straight from their 10Q, and it's also in their 10K, their annual and quarterly reports. 28% of the loans funded are retained by the originating bank. 65% of the loans are able to be packaged and spun out. And then 7% are funded by balance sheet, which means they're keeping them in-house, they're getting an interest rate on it, et cetera. Okay. That's normal times. And in past years, it's been lower than that. But this last year, they've been having to eat a lot of their loans. So that is the story as it currently sits. Okay. Your real problem right this minute, if you are an investor, is you got to figure out, given that they're not able to pass these loans off, did they or did they not write decent loans? And will they or will they not have access to capital to keep doing what it is they do? Two things. All right. So that simplifies it a lot. And now we're going to go through the financial statements. I'm going to show you some of the things that I saw that are okay, some of the things I saw that are maybe less okay, or at least would scare me if I was in the stock, if I was considering the stock. So let's go through it. First and foremost, this is a little bit of a red flag. Okay. Yes, it is the case that total revenue came in less than expected, but it's the actual composition that bothers me. So number one, they made less revenue from just fee income from writing volumes of loans. There were less loans. We know there were less loans. I just went through Carvana the other day and I told you they sold less cars. So of course they made less loans. So it's just as a bellwether. So yes, less loans, but here's the one that is concerning. Interest income and fair value adjustments net. What is that? That's the loans they kept on their balance sheet. So we're going to have to investigate that deep dive style. That's your first red flag. And we're going to track that through the three statements that come in any company report. The second thing that bothers me, is this right here, engineering and product development, 37 to 66 is what happened on the quarter. We always have to know what you mean. You spent more in R&D, you're making less money. What's that all about? Now realize it's about 30 million increase in theory in R&D, engineering product development. Remember, this is a lender. So that can only be one of two things, staff or systems. And we about to find out which one it is. And you would think it better not be staff. So let's go into that now that we understand what it is we need to look for going forward. Okay. First thing is we look up very clearly, just in case they named it something special, because it is not common to call R&D engineering and product development engineering. Okay. So here it says, and it tells you it consists of payroll and other personnel related expenses, including stock-based compensation expense for the engineering and product development teams, as well as cost of systems and tools used by the teams. Well, hold on a second. You got to think about that. Is this some kind of really fancy machinery that they're building? No. All right. It's like a data center and then maybe a couple of computers. So you already are kind of like, you should be like, did you just pay a bunch of people a lot more in stock? Is that what actually just happened? All right. Well, let's take a look at the cash flow statement because it'll tell you that just as clear as day. Here's the cash flow statement. Aha, red flag. Stock-based compensation went from 50 to 92 million. That is a 42 million increase. That's bad. And let me tell you why it's bad. Let's go back to the income statement. 30 million increase in R&D, 42 million increase in comp expense. That actually means that you didn't really buy more equipment this quarter. You just paid people more to keep them around because, whatever it is that you needed to keep them around. That one, if I was an investor, I would have to really better understand that. It was not something that came up on the call. I can kind of understand why it wouldn't be because they'd probably just never let you on the call again. And that's a fair point. But that is what it is right there. Now, the other red flag relates to the thing that I told you about, which is the interest income and fair value adjustments. The cash flow statement is going to show you whether they've been getting loans off into the races. And we can see this purchase of loans held for sale going from 80 million to 1.4 billion. That's a little bit of a bigger increase. Now this, they did talk about on the call a little bit, and they talked about it in the context of the fact that a lot of the loan market had just shut down and that some of the big banks are starting to write that business again. When you got this crazy interest rate increase, that's bound to happen. So then this is what the balance sheet looks like right now. Loans at fair value, you can see a massive increase there. They have borrowings to match it. So far it should be okay. This is a 900 million timing increase. But the one thing that that's why I said this is the one thing, okay? The one thing that could mess this up really fast is if they wrote those loans poorly, which means they're going to take an L in a couple of different spots. It could be kind of nasty. All right. So that unfortunately, we're really dependent on this AI to write it, to have written the business correctly. And let me show you why it's a little bit gray that you would think. Let me show you why it's a little bit gray. Okay. Here's the loans at fair value. Oh, sorry, I must have printed it twice. Sorry. Okay. So the condensed balance sheet tells you that there is enough assets relative to the liabilities right this minute. Okay. EBITDA is very negative. So like I said, if they didn't write these loans right, this is going to burn a hole in their pocket for quite a bit. And then because of the nature of what this business is, it will become harder and harder to find that financing. Here's the mix of loans before I get through to the risk components, which I know can be a little bit tougher for some folks, but we got a lot of auto loans, right? That's 400 million auto loans, up 73%, which is interesting given that we do know that in this last quarter, there's been a decline, but somehow they still managed to write about 10 million more in auto loans. And then core personal loans is up quite a lot, up 62%. It wasn't clear to me what exactly that was, but they did increase the number of loans held on balance sheet, meaning they're retaining it at this point. Okay. Their argument for why it will be okay is that the defaults followed a stimulus driven period where defaults were approximately 50%. The increase in defaults followed a stimulus driven period during 2020 where defaults were approximately 50%. Now that didn't totally make sense to me. 50% below expectations. They're saying that a reversion to the pre-stimulus default rate and a shift in credit risk profiles accounted for a large majority of the increase in late 2021 and beyond. But they're saying that it's just shifting back to normal times. Okay, is it or isn't it? Okay, they're not a normal bank where there's a bunch of deposits held against it. They're not doing this the same way that every other bank is. They're saying they're doing it better, and they're saying it's just a reversion to 2021. But this is an awful lot of cash to be holding, and also the market closed down on him versus like the pre 2021 where you didn't have that. So this is what they're seeing, and this could still absolutely be right. Okay, this could still absolutely be right. Here's the other part of what they're saying. These are the cash flows from it. They're saying that, but before we go on to the next one, the real challenge for me is that I can't tell what they trained their AI data on. Okay. This company's been around since 2013. Here is the 4-year vintages, since most car loans are 5-year blocks, so to speak. So they're looking at 2019 and seeing things be lower than expected for a while. And now we're coming back up and maybe even a little bit beyond in the next quarter. But we're really, the data we're giving us through 2019, with all due respect, that ain't the right way to do an argument if you're trying to convince me that things are going to be okay. The second argument is a little bit weak too, because still we only have data from 2018 on targeted cash flows that they wrote versus whatever. So the challenge for me in their deck and in the conversation is that they're telling me they feel good about how the model's behaving and how it's reacted because they did really well these last 2 years. So they just see it as a correction versus we really stress this against other stressful periods where interest rates were rising and doing this kind of thing, or even a 2008 period where you just didn't have access to capital for X number of months and had to eat the loan and sit there and manage it, and the default rates associated with it. Okay, now let me tell you why that's a problem here. I'm going to share my screen one last time and try to go through this risk stuff. I hope that I do this in a way that is not difficult for you to understand. But the problem with this is because the data points I would have needed to feel better, and maybe they can just provide it, because surely if they've got all this data engine, they can provide it, is that all risk during these distress periods follows a Poisson distribution, not a historical time series. Well, technically Poisson is historical, but anyways, the point is that this is the thing that came out of 2008, that if you were alive then, you couldn't possibly do risk and not understand this concept. And that is that you have this concept of correlated default. So what is a Poisson distribution? It's essentially a type of distribution analysis that you do that, it's a type of analysis that you do in statistics that is about the fact that there's a time component to an event happening, namely default risk. Okay, so in a really wonderful environment, you got one guy that comes out, he defaults maybe because you wrote it wrong right away. Then the second guy comes out months later, but it's really, really small amount. And then you don't get any default for the rest of it because that was really it. Just the human error of writing it a little bit wrong right up at the front. Risk people don't hate me. I'm trying to simplify this for the masses. Okay, but if that hazard rate, if this thing is actually written incorrectly for a really difficult period in the marketplace, then you get curves that look more like this, which is you get a little default that happens because you wrote it incorrectly. Then you get more defaults happening in the next set of defaults. And then you get more defaults and more defaults and more defaults. And then it's just the case that the whole vintage, all of the loans that you bundled up and passed off, which are currently in-house, they all default at the same time because the way that was written was such that you didn't take into consideration a fairly meaningful factor, namely that you working in the subprime space and everybody has the same kind of potential inability to pay their loan at the same time. That's what this math attempts to describe. And there's lots of things that you can do that you could show me from a risk perspective that would help me understand that that's not the case here. One of them would be you would do the time to default buckets and show me that very clearly. Another would be you would indicate clearly to me different types of diversification that surely are not that issue that we're seeing. And then there's, I mean, that's just off the top of my head. If you wanted to have me sit here and do all of them, I would, but we're not going to. We're going to keep going along so we can move on here. But I would need to see more like that. The only risk metric that I saw is a legit metric. It's more of okay. So sorry, before I go into the risk metric they showed was this. Hold on. it was a more of a stress test. So it was those two plus a stress test off a different, oh my goodness, I feel so bad. Here we go. It's more of a scenario test where they were telling you what the sensitivity loss would be to an increase in rates or credit losses or expected payments. Now, usually you'd also do all three scenarios at the same time, since this would probably happen all at the same time, and then you would get a number, etc. Um, I'm not for sure that this is quite the way you want to do it if there's a situation of correlation among all the things, but all right, we'll let it go. Um, it's a little too minimal for me, but it's not like they aren't trying, or I think that there's something truly awry here versus like what we're seeing in some of this craziness, FTX and stuff. No, this is actually a standard analysis. It's just I would need to see a lot more, since now the whole aspect of your business is totally different. It's you loans way more than I would have expected. Now they're saying this FICO score is what protects them and shows them that they have less default, but unfortunately the things they showed me weren't comparing their buckets to other people's buckets. It was just them showing how their buckets traveled through history. So this isn't quite, it wasn't quite the right analysis for you to make arguments and understand what's going on. All right, sorry, let me go back. And the reason this is so important is because when you look at this, you can see how big this interest expense is getting and how much between the interest expense and the fair value of what those loans are actually worth in your balance sheet, the hole that it's poking in there is pretty significant. Hence, that's why I say you really got to figure out if these guys wrote the loans correctly or not. Now, I'm going to give you two things that make it really difficult, and I hope that no one gets mad at me, but I just got to report what I see. But these are two legit things that bother me personally if I was to come in here at any price, because usually I might be able to tell you if it's just slightly over something, but I can't because of these two things. And the first thing that makes it really hard is that you would need to understand this risk disclosure number 4. Cross River Bank is still about, is a huge percentage, 58% this year, 52%. So it's actually increased as a percentage of the total loans that they write. What is Cross River Bank? All right, here's the deal. The CEO has been at this business for 15 years. Before that, he started out at Bear Stearns. Then he went to Barclays in banking, good bank. So Bear blew up in a blaze of glory, Barclays, but much later in 2008. But it was a good place to start. Then he went to Barclays. But during the 2004 to 2007 period, he lists First Meridian as the bank that he was at. But First Meridian during 2004, 2007 was called Trump Financial, which did in fact blow up a blaze of glory. And then almost immediately he starts this bank. I'm not going to say anything nasty there at all, because I'm sure that 15 years, the man learned a ton. And certainly he learned to write loans effectively and get them off of his balance sheet. It's just whether these young kids actually, well, I mean, they're not all so young. I shouldn't be like that, but it's just whether or not he originated a lot of amazing loans, or if this is not the case. Now, you would have to know the answer to that and understand it clearly. So if someone is able to express that to you very, very clearly, then fine, awesome. And I apologize if I'm insinuating something else. But really this is a big issue, because it's such a big component of what's actually comprising the loan is this one originator. Okay. The second thing that really bothers me is that this is the leadership composition, who are incredibly successful individuals, way more achieved, I'm sure, than I can be at comparable stages in career. But the problem is none of these people come from the debt side of the business in any kind of meaningful way. All right. Paul Gu, he has listed for his debt experience, his internship, originating microfinance loans. And otherwise, it's really scattered. It's unclear to me that this is the kind of leadership composition or board that would really understand how to navigate a little bit of a tougher credit environment in subprime. Now, I may be the biggest jerk, because possibly there's something on each one of these guys that's hidden in the board positions, or something else that they just know that I'm not understanding. But as it sat, when I read bio by bio, I didn't see it. I saw a lot of people in equities, and I saw a lot of people in private equity, but that is not what gets a loan done. What I'd love to see, and could be a really good positive for the stock, is them bringing in a different sort of headcount. They sure spent a lot on headcount, but looks like it was all in technology. So that would be something that could be a positive. They bring in someone with a little bit of a different experience in some portion of this composition, because I think for surely, if that was the case, we would have seen a slightly different way of doing the explanation to investors that things are going great on the investor call. And with that, that's all I have prepared. But that makes, because unfortunately my background really has me, when I look at banks, focused on risk. And because of what I'm seeing happening currently in the business strategy, which is the business itself is taking on a lot more risk because it isn't able to pass that off. That's where the buck stops for me, because those kinds of situations are just really hard to tell what happens. That's all. Sorry. How you doing, David?
Oh, hey, excuse me. Hey, man. Are they excuse me, they do car loans, or they do
Car and personal.
pay later? Are they a pay later company?
They do have, I think, one piece that does that, but mostly it's just classic car and personal loans.
Gotcha.
They are trying to expand. See, that's the thing, is the call was really about, as soon as this opens, we're going to be able to do all these wonderful things. I need to see that. You know what I mean? I need to see them just get past this one period. I just assume they calm down on expanding and just make sure that they can get through this period. So like a lot of things that could be positive, where I would change my opinion on a dime. Number one, those loans get off the balance sheet such that it goes back to some much lower number, right? Because right now that is a much higher number, 80 million to 1.4 billion, right? That totally changes what this business is. So if that happened, I would, zip it immediately. If they brought in someone with a lot more debt experience, I would feel a lot better. If they were able to diversify away from this one originator, because you're really dependent on the honesty of that one originator. I'm not throwing any disparity towards that person, but realize that one originator means that it's really hard to diversify origination risk, which is a real thing.
Got it. What are there's quite a few companies going into these car loans.
Yeah, that's true too.
What happened to cars? I mean, was it COVID, the shortage?
Yeah, I mean, I would say yes and yes. And in general, it's the subprime market that is always a little bit of a special animal. So the banks in general, definitely, during COVID with rates at almost nothing, they just needed to get lending exposure, period. Because you're still a bank. You can't hold cash with inflation doing what's doing, because you're going to be running a hole, right? And the risk-free assets, which would typically we think of as US Treasuries, that
Right.
wasn't giving you any kind of yield. So you had to go up the risk spectrum. So what you wanted is to source more auto loans, which actually was an uptick since they weren't defaulting in any kind of meaningful way during the first parts of the COVID situation.
Right.
Student loans were a little bit awkward. Some of the banks took more student loan risk and they did just fine. Some did not. And then
Okay, so it's a result of the free money, yeah, in 2020.
it is a result. It is a result of the free money, but it's also a result of the fact that with rates so low, you're still a bank. Now, if you realize a bank, all banks, they make money off of two things. They make money off of fees for you getting financing or whatever it is. And then they make money off of the interest margins. Okay. But you can't get no interest margin when rates at 0%. So usually somewhat healthy, people will quote, is 250 point spread between the front and the back. So basically you're taking in deposits, you're giving people nothing for their deposits, you're going to lend it out and have that spread be 2.5%. Okay. During COVID, you were lucky if you got 2%. Okay. I think at one point, some banks were only getting 150, 175 basis points on that spread. That does not cover your operating costs. It's not ideal for that to happen. So now interest rates have risen like crazy. And for whatever reason, they can either just buy treasuries and chill out and do nothing, lend not at all, or they can just go ahead and charge more on the loan because rates are increased. And so they could just tell you, hey, friends, the rate's increased, eat it, And that is what it is. They don't need to go to the more difficult components of lending. They don't need to lend out subprime anything. They just need to chill out and see what happens with rates. And so that's what's happened. That's what's closed down the subprime market for a lot of folks. But like I said, the subprime market, if you wrote that debt correctly, is fine, right? The only risk that you really retain is the principal component that's good, the bond, the face value of the bond, which is going to swing around like crazy, and you have to eat every single one of those marks, and until either you sell the loan off or that loan collapses and you're able to just be done with it. Hallelujah. It's not a good state of affairs for them right this minute, because that's what's going to look like, ugly as anything on their balance sheet income statement. And it's just whether or not this young management team knows what to do.
Yeah, it seems like that you're loaning a depreciating asset to subprime borrowers.
Yeah, the depreciating asset being the bond, not necessarily the car even.
No, I'm talking about the car.
I mean, the car's already been sold out. So if they default, then yeah, it affects the hazard rate, because you got to get, so if an auto loan defaults, then you remember that, that film back, I think it's like early 80s, late 70s, Repo Man.
Yeah.
That's a legit show if you're trying to understand debt financing. Hey, listen, I tell you, look, when I had to learn this markets, I had to entertain myself.
Oh, funny.
And I have no, was it Emilio Estevez? No, this is younger, right?
Morgan Stanley just came out and said Tesla was the #1 pick for 2023.
Thank you, Morgan Stanley, because they should be right.
But they hold a lot of his debt too, right?
That's true too. But look, this company, Tesla doesn't have a lot of debt on balance sheet, right? But I guess
I
do have a lot of Tesla because it's collateralized against the Twitter. That's what you mean, right?
Yeah.
It's a personal loan. They'd like to see Elon succeed, in other words, so that they don't have to figure out Tesla.
Okay, thank you, man.
All right, yeah, let's get to it. Let's get off so you guys can watch the meetings. Take care. See you tomorrow. Bye.